Hello everyone. In this video, we are going to discuss what is the best way to invest in dividend stocks and answer the question, is dividend investing a good strategy? By the way, I hope you are having a good day so far. So what exactly is a dividend? In a very simple example, it's when you buy a company's stock, the company does well, and as a result has excess cash. With that excess cash, the company can use some of it to reinvest into the business operations in order to grow and or give a cash dividend to you, the shareholder, as a reward for believing in them. Consider it your piece of the pie for being an owner of the company. Pumpkin pie is the best kind of pie out there. When you first start out your journey as a dividend investor, you will inevitably be chasing the yield. Why? If you're anything like me, you compare the dividend yield to that of a banking high yield savings account. It's simple math. Would I rather want a 2% return on investment on my cash or this dividend stock with a 9% dividend yield? However, I am here today to tell you that ain't it. Please hear me out when I say my worst mistake was investing in the dividend for dividend's sake, which meant I was buying a company's stock because of their high yield, even though they clearly had a mediocre track record. If you chase the yield, what this tells us the investor is the company usually has a high payout ratio, meaning it's not sustainable from their cash flow, the company has limited growth, and the company will be on track to slash the dividend so they don't go bankrupt. Best case scenario, if the company can sustain the high juicy dividend, it is most likely a mature company that has limited room for expansion. So the stock price will most likely trade sideways and you'll just pocket the dividend. Speaking of pockets, why in the world do they even make jeans without any pockets? That's a fashion trend I just can't get behind. Same with pockets that are shallow to the point where your keys and your phone just fall right out. I feel bad for the ladies because apparently most of their pants come without pockets. I just couldn't. I just can't. Alright, so instead of the dividend yield, the best way to invest in dividend stocks is to pursue and invest in high quality companies with an economic advantage in their industry, have a solid balance sheet, and are growing their business alongside the dividend. Why? This way, the dividend payout will grow at a high, sustainable rate, and you get capital appreciation. If you buy a stock at $10, wouldn't you like to see it at $100 in 10 years? Don't buy a poo-poo company for $10 with a 10% dividend yield just to have it trade for $8 in 10 years. There's so many companies out there that resemble this example. However, on the flip side, a great example of a high quality company that shows growth in dividends and in its stock price is Costco. Check this out. Back in 2011, Costco paid 96 cents in dividends every single year, and the share price was $52. You fast forward to 2023, now the dividend payout is $4.08 a share, and the company trades for $660 a share. This is a dividend compounder with cheese. And by the way, on a side note, everybody raves on and on about their hot dog and drink combo, but in my personal opinion, I think their pizza just slaps, and you can't prove me otherwise. Their pizza is actually genuinely good. High dividend yield stocks are generally short term because they end up cutting the dividend and over the long run produce an ugly, filthy, dirty return on investment for a 10-year or 20-year horizon. Coming up, I'm going to show you examples of companies that once had juicy dividend yields that ended up being high yield traps. The benchmark we are going to compare it to is going to be the market in the same time period. So the market is the S&P 500 and S&P 500 is essentially VU. And if you want more details about VU, then please don't hesitate to check out my video about VU. And if you want to buy VU t-shirts, well, unfortunately, I don't sell those. Alrighty, so the market in the past 10 years has returned 217%. And when we break that down year over year, the CAGR is in fact about 12%. Now we are going to talk about Pfizer. Pfizer is essentially a high yield trap. In 10 years, Pfizer has returned 45%. And you might have been interested in Pfizer because back in January 2021, their dividend yield was 9.4%. Even though the dividend yield is juicy, the total returns not good. Moving right along, we are going to talk about VF Corporation, the parent company for the North Face and Supreme, Vans, and some other brands. So in 10 years, VF Corporation has returned negative 56%. Yes, you heard that correct. Negative 56%. You actually lost money if you invested in VF Corporation. However, by ignoring the history of the company, you might be interested because you saw that back in June 2023, VFC had a dividend yield of 8%, yet the total return is a hot mess. And the last example that I want to show is AT&T. So in the past 10 years, AT&T has returned 33%. However, you might have been interested in AT&T back in 2023 because of the high dividend yield and thinking that it's undervalued. Now, what you see on your screen are examples of companies that once had a juicy yield but terrible business fundamentals, a weak balance sheet, and below average intangibles that forced them to stop or cut their dividend. Another reason why you want to avoid high yield dividend traps. So even though the idea of getting a 15% dividend yield sounds fascinating and attractive, it is almost always temporary or short term. More often than not, that dividend yield is going to be slashed back down to a 2% dividend yield within probably like 12 months or so. And on a side note, what is up with companies that are blue and cutting their dividends? And another question that I have for you is, why is blue or red the favorite color choice for most males? Unless you were the booger picking kid who liked the color green, you weirdo. Okay, now we know to avoid the high yield dividend stocks that are usually a mess inside, despite looking juicy on the outside. So instead of getting infatuated and turned on by a stock's high dividend yield, what should I look at instead? You talked about a high quality business earlier. Can you be more specific? All right, I can be more specific, and I'm going to use Hershey as an example. And here are some of the metrics you want to take into consideration. This is not the full list. The first thing that you want to take a look at is the payout ratio. Is the dividend affordable? Is it sustainable? For Hershey, their payout ratio is hovering at about 50%. This is a green light. You never want to see the payout ratio above ideally 70%, at a maximum about 90%. Once it starts getting into that territory of hitting 3 digits of 100% or even 110%, you can almost guarantee that the company is indeed going to freeze, slash, or even cut their dividend. The next thing that you want to take a look at is the dividend growth rate. How much is the company growing the dividend year over year? Are the dividends increasing? In the case of Hershey, you can tell that they are growing their dividend payments by 15%. This is really good. As a minimum, what I like to see is that the company is at least growing the dividend by the rate of inflation. So historically at about 3%. If it's not growing at about 3%, then we hold it against the company. Shame on you. The next metric is going to be the free cash flow. You want to see whether or not it is increasing year over year. And it's just one way to determine if the operations of a business are profitable or not. And in the case of Hershey, it just looks phenomenal. And the last metric is going to be the dividend history. You don't just want to look at what's happening in the short term to see the bigger picture, but also the consistency. Are they paying the dividends on time? Are they growing it? What does it look like? So in the case of Hershey, back in 2004, the dividend payout was 48 cents. However, as you fast forward throughout the years, as their share price was trading sideways, they were increasing the dividend payout. And as we go forward through the Great Recession, they were increasing that dividend payout. And as you can see on your screen, the stock price was going up alongside with the dividend payout. So when we look at the history of Hershey and their dividend, this is amazing. This is beautiful. This is like love at first sight. If you're still not convinced that high quality companies are the answer and you still want a high dividend yield at like 9% or something, then it comes at a cost. You're going to want to look at REITs, closed-end funds, or BDCs because those types of companies tend to pay higher dividend yields. Those dividend payments are going to be taxed at your income bracket rather than at the qualified dividend tax bracket of 0%, 15%, 20%, unless it's in your Roth IRA account. However, I want to circle back and try to answer that question. Is dividend investing even a good strategy? Let's go ahead and look at some facts. First up is going to be Apple. So in the past 10 years, Apple has returned 1,000%. Their dividend growth rate has been at 4.4% year over year, which is at about the rate of inflation, and the payout ratio is sitting at 15%. Are you going to tell me that a 1,000% return on investment is not worth it? This is a dividend compounder with cheese. Example number 2 is Microsoft. In the past 10 years, Microsoft has returned 1,000% as well. The dividend growth rate is sitting at 10% year over year, and the payout ratio is super low at 29%. Oh, stop it. That's because both companies are in the tech industry. I'm going to give you a third example. Number 3 is going to be Texas Roadhouse. In the past 10 years, your return on investment was 423%. The dividend growth rate, almost 20% year over year. The payout ratio, really healthy at 50%. Just to remind you, in the same time period of the past 10 years, the market has returned 217%. So is dividend investing a good strategy? I think the data speaks for itself. Dividend investing is a solid strategy if you are satisfied with that kind of return on investment of your cash that we saw with Texas Roadhouse, Apple, Microsoft. This is not going to be like cryptocurrency or sports gambling where you can triple your money overnight. It does not work like that with dividend stocks. It takes time for the dividends to compound and snowball. Eventually, with enough dividends, we will be able to order an extra slice of cheese when we go out to eat. Jokes aside, dividend stocks will create you wealth. When you purchase a successful dividend stock, you purchase a financial product that will pay itself back over time, as well as bring you additional income in the future. When you purchase a dividend stock and hold it forever, sometimes you have to sell if things go south, but just follow with me when I say forever. You are essentially looking time in the eye and saying, we work together now. Hush and let it happen. This is not financial advice, but I believe when it comes to average investors, time is our most reliable ally. Time in the market is better than timing the market. Alright, so dividend investing, pretty good. So let's talk about strategy. So there's multiple schools of what is right in dividend investing. The answer depends on you, your risk profile, your preferences, and especially where you are at in life. But here are the two most popular strategies. There's dividend investing with an emphasis on a steady stream of dividend payments for income, typically preferring higher yields in lieu of company growth. These are people who prioritize and enjoy passive income because they want to replace their active income salary to pay for the bills instead. These folks love mature companies like what you see on the left side of your screen, such as Realty Income Corporation, one of the most popular REIT stocks, or Main Street Capital, which is an example of a BDC, Coca-Cola, IBM, Procter & Gamble, etc. As a stereotype, these folks tend to be in the retirement age or category. Not always, but often. So the name of the game for dividend income investing is safe and steady dividends to replace their salary. And they usually drive a Honda Accord or Toyota Camry. Just kidding, but it could be true. Then there's dividend growth investing, which focuses on CAGR and growth more so than the dividend yield in the present tense. This type of investor tends to be younger or have a longer investing horizon of perhaps 20 to 30 years because they're not retired yet. They like to look at the bigger picture because total return is more important than, say, a 5% dividend yield right now. The companies they invest in tend to have small dividend yields because the company's primary objective is to grow more so than giving cash back to the shareholders. These people prefer stocks like what you see on the right side of your screen, such as Texas Roadhouse, Apple, Visa, Nvidia, and even Domino's Pizza. A dividend growth investor's objective is to build a portfolio that beats the S&P 500 on average by prioritizing the higher growth companies with the risk of increased volatility. Usually by focusing on companies that are growing in the right metrics like free cash flow, revenue, and net profit margin, the total return for such high quality companies will be an afterthought and will most likely beat the market. Dividend growth investors believe in the mantra of focus on the right company traits and the market beating total return will follow. Personally, I blend both because I like both methodologies. They're both correct. It does not have to be a hard rule or religion or be mutually exclusive. Anyways, if you have any questions, let me know. By the way, what kind of phone do you have? And are you happy with it? I am in the market for a new phone right now because mine is coming up on 4 years and it's showing signs of being slow and glitchy. With that said, have a wonderful new year. Dividend compounders with cheese, signing off. Stay safe.